Welcome to the Deep Dive. Today we're taking a close look at the latest from Rockhopper Exploration Flag, specifically their full-year results for 2024. They just came out, May 29th, 2025.
That's right. And our source here is the company's own official RNS announcement, the one titled Final Results. So it's straight from them.
Yeah, and Rockhopper, for anyone needing a quick refresher, is an oil and gas exploration company. Their main focus really is the Sea Lion project up in the North Falkland Basin.
Though they also have these legacy interests in Italy that play a pretty big role in the story this year, as we'll see.
Okay, so our mission here, for you listening, is to unpack this pretty detailed announcement. We want to cut through the jargon, understand what progress they've actually made.
Both last year and more recently.
Exactly, and pinpoint the challenges, because there are definitely still hurdles, and ultimately figure out what it all means for their big goal, getting Sea Lion sanctioned.
Right, getting that final investment decision. Think of this as your quick guide to the really crucial bits of this update.
It's quite a snapshot, isn't it? You've got complex financing, resource updates, international arbitration, even tax disputes.
All swirling around trying to get this major offshore project finally moving after, what, 2 decades? It's a lot to juggle.
It really is. So let's dive into maybe the biggest piece, Sea Lion itself and the path towards that FID.
Okay. Well, the company's framing this recent period very positively on the financing front. They actually called it the most material positive development to date.
That's strong language. What's behind that?
Well, the operator, that's Navitas, they've signed a mandate with a lead technical lending bank. That's a concrete step.
And the plan now explicitly includes senior bank debt.
No.
That feels significant.
It is significant. It's the first time that's been formally part of the plan. It suggests, a more traditional, perhaps more robust project financing structure is taking shape.
And they're mentioning positive initial feedback from other capital providers, too.
Yes. So it sounds like the broader engagement with the market is, well, encouraging so far.
But this financing work has shifted the timeline a bit.
Just slightly. The target for FID is now expected in the second half of 2025. They say this gives the lead bank enough time for their due diligence.
Which is always thorough.
Exactly. And it allows time for the whole financing scheme, the syndicate, to come together properly.
Okay, so financing is moving. What about the actual resource, the oil?
Oh.
There's an update there, too, based on a Navitas report.
Yes, a new independent report that Navitas commissioned, and it's a pretty chunky number.
Oh, chunky.
Gross 917 million barrels of 2C contingent resources, plus upside, and remember, Rockhopper's slice of that is 35%.
917 million barrels 2C. How does that compare? I recall the older number being much lower.
It was. The last independent report Rockhopper themselves commissioned back in 2016, that was 517 million barrels 2C. So yeah, this new Navitas commission number is substantially higher.
That's a huge difference. Are Rockhopper validating this themselves?
They are. They've commissioned their own updated independent resource report. It's due out shortly, and they say they expect it will, quote, corroborate this significant resource base.
Okay, so confirmation of a much larger project, essentially. That must help with financing talks.
You'd certainly think so. A bigger resource base makes the whole thing look more attractive long-term.
And the plan for getting that oil out, the development concept.
Also updated based on the Navitas work, it's a phased approach. Ultimately, 5 phases using 2 FPSOs, those big floating production units.
Look, starting smaller.
Right. The first chunk of development combines the first 2 technical phases. That'll use a single FPSO developed through 2 drilling campaigns.
Got it. Now let's talk specifics on Rockhopper's position. We know their interest is 35%. What about the funding support from Navitas? Those loans are key.
Absolutely crucial. First, there's the pre-FID loan. This is already being used. It covers most of Rockhopper's share of the Sea Lion Phase 1 costs before they hit FID.
And that's carrying interest.
Yes, at 8% per year. As of the end of 2024, they'd drawn about $15.3 million on that, including the interest rolled up.
Okay, and then the big one, the post-FID loan.
Right. This one kicks in only if they reach a positive FID. And Navitas provides an interest-free loan. That's the kicker.
Interest-free? Wow. For how much?
It funds 2/3 of Rockhopper's share of the Sea Lion Phase 1 development costs. Specifically, the costs that aren't covered by any third-party project debt they raise.
So Navitas is effectively covering a large part of Rockhopper's equity contribution, interest-free. That's massive.
It's a huge help, yeah. really eases the burden on Rockhopper at the point of sanction.
And how do these loans get paid back?
From Rockhopper's share of the cash flow,
Hmm.
specifically 85% of their working interest share free cash flow from Phase 1 once it's up and running.
Okay. The report also breaks down the developed barrels, right? Not just the total resource.
It does. Across all 5 phases, the total estimated developed barrels come to 730 million.
And the initial phases.
The first 2 phases in the northern area, which make up that initial single FPSO development, account for 319 million developed barrels. So a very solid start.
And what kind of production rates are they looking at?
For that initial Phase 1+2 development, peak production is estimated around 55,000 barrels a day.
Okay.
But once all 5 phases are online, eventually it could ramp up to 150,000 barrels a day. So significant scale long term.
What about the cost? The Phase 1 CapEx.
The estimate for pre-first oil capital expenditure just for Phase 1 is US $1.4 billion.
$1.4 billion. And the break-in price.
They estimate that across the first 3 phases, the production break-even is around US $24 per barrel, which, looks pretty competitive in today's oil price environment.
Definitely. And just quickly, the relationship with the Falkland Islands government, FIG, any updates there regarding project approvals?
Rockhopper seems confident. They state they believe the necessary consents from FI will be forthcoming in a timescale allowing formal FID in H2 of 2025. So they seem to think that won't be a bottleneck for the current timeline.
Okay, so that covers the project itself. Let's shift to Rockhopper's overall financial picture for 2024. Because as you mentioned, there was a pretty dramatic swing.
Huge swing. They reported a profit of US $47.6 million for 2024. Compare that to a loss of US $4.6 million the year before, in 2023.
That's more than a $50 million turnaround. And their cash improved significantly, too.
Yeah, cash and term deposits more than doubled. Ended 2024 at US $20.9 million, up from $8.0 million at the end of 2023.
And the main driver for both the profit swing and the cash jump seems pretty clear, that monetization agreement linked to the Umbrina Mare arbitration award.
Absolutely. They sealed that deal and got the first payment, tranche 1, which was US $20.6 million in cash during the year. That landed in June 2024.
Now, this monetization agreement sounds a bit more involved than just getting a check. Can you break down the structure and its impact?
Yeah, it's not just a simple payout. They signed a deal with what they call a regulated specialist fund. Think of it like selling a portion of the potential future award money up front, plus some complex sharing arrangements.
So tranche 1 was the upfront cash Rockhopper got to keep.
Right. $19 million, which translated to that $20.6 million they received. Part of the initial payment, about $26 million, went to the funder who backed the original arbitration case.
Okay. What about future payments? Tranche 2.
That's the contingent part. Another $65 million is due if Rockhopper successfully defends Italy's attempt to annul the award. So if the award stands, they get more money.
And there's a floor on that.
Yes. The deal guarantees that even if the award is partially annulled, the total Rockhopper gets from tranche 1 plus tranche 2 won't drop below $45 million combined.
Interesting. And a potential tranche 3 as well.
A smaller potential kicker, yeah. A 20% share of any recovery that goes above 200% of what the specialist fund put in. So more like upside potential.
So how does all this complexity translate onto their financial statements? That big profit number wasn't just the cash received, was it?
No, and this is a really key accounting point. They didn't just book the $20.6 million cash. They had to estimate the fair value of the entire monetization agreement on day 1, including the expected value of those future contingent payments, tranches 2 and 3.
Ah, okay.
That initial fair value was calculated at US $79.8 million. And that entire amount was recognized immediately as other income in their profit and loss. That's what drove that massive profit figure.
So they booked the potential future income now.
Essentially, yes.
No.
The $20.6 million cash is part of that $79.8 million. The rest, the estimated value of the future potential payments, sits on their balance sheet as a financial asset.
Right.
It was about $58 million at year-end, listed under other receivables.
Right, so it makes the P&L look great and boosts the balance sheet, even though most of that money isn't actually in the bank yet and depends on winning the annulment case.
Precisely. It's important to understand that distinction when you see that headline profit number.
Got it. What else stood out in the financials? Admin expenses were down.
They were. Down to $3.3 million from $3.8 million. And the reason ties back to Umbrina Mare again.
How so?
In 2023, they spent $1.6 million on legal fees fighting Italy's annulment attempt. But under this new monetization deal, the specialist fund pays those legal costs now.
Ah, So Rockhopper didn't have those costs in 2024.
Exactly. That saving was partly offset because they paid out some discretionary staff bonuses from the Tranche 1 catch they received, but net-net, admin costs were lower.
Finance income was up too.
Yeah, partly from earning interest on the higher cash balance, but also due to an accounting item called the unwinding of discounts on the fair value of that monetization agreement asset, basically recognizing the time value of money on those expected future payments.
Yeah.
That added about $1.3 million.
Okay. And other expenses.
About $1.0 million, mainly covering costs to set up that monetization deal and also the cost of an insurance policy we should talk about later.
Right. And they also brought in a bit of cash from warrants.
Just over $2 million, yeah. US $2.2 million net proceeds from people exercising warrants during 2024.
One other financial piece, the disposal of their Italian business. This is separate from the Umbrina Mare case, right?
Correct. This is about cleaning up the rest of their legacy Italian footprint. They signed a deal in October 2024 to sell the subsidiary holding those assets and liabilities, Rockhopper Civita, limited to a company called Zodiac Energy.
And this is now treated as held for sale and discontinued operations.
Yes, standard accounting for a business unit being sold, the assets and liabilities are separated out.
What are the terms of that sale? Is Rockhopper getting paid?
Actually, Rockhopper is paying Zodiac, but not much. $3 million when the deal completes, and potentially another $2.5 million later, but only if Rockhopper wins the Umbrina Mare annulment defense and gets at least $10 million from the award.
So why do it? What's the benefit for Rockhopper?
Getting rid of the ongoing costs and, crucially, the long-term decommissioning liabilities associated with those Italian assets. That's the main prize here.
How much were those liabilities?
They totaled US $14.3 million. So offloading those is a significant cleanup of their balance sheet. They're now reclassified as liabilities associated with assets held for sale.
And when does this Italian disposal actually happen?
It still needs regulatory approvals from Italy and the Falklands government. They expect it within 12 months, but the timing is a bit uncertain. But strategically, it simplifies things a lot, letting them focus purely on the Falklands.
Okay, so project progress, a transformed financial picture thanks to the arbitration deal, and cleaning up the Italian legacy assets. Now let's dig into the risks and uncertainties that are still very much present. Starting back with Umbrina Mare, that annulment process is still ongoing.
It is. Italy hasn't given up trying to get the award canceled. There's no fixed timetable, and Rockhopper now thinks a decision might slip into the second half of 2025. There was a hearing back in April 2024.
But Rockhopper remains confident they'll win.
They state they and their advisors are confident in their arguments, yes. But it's still a legal process with inherent uncertainty.
Which brings us to that insurance policy you mentioned. This seems really important.
It's very important. They put this policy in place back in October 2024. It's basically a backstop.
What does it guarantee?
It ensures that even if Italy wins the annulment case, partially or fully, Rockhopper is still guaranteed to receive a minimum total amount. The combination of any potential Tranche 2 payment they might still get, plus the insurance payout, will equal no less than $31 million.
So win or lose the annulment, they are guaranteed to get at least $31 million total from the combined deal and insurance.
That's the protection it provides. It puts a floor under their proceeds from this whole Umbrina Mare situation. The policy cost them $4 million in total.
Okay, that significantly de-risks the outcome of that Italian saga for them. Let's switch back to Sea Lion funding. This seems like the biggest hurdle for Rockhopper specifically.
It really does. They are quite clear about this. Remember that post-of-easy loan from Navitas covers 2/3 of Rockhopper's share of Phase 1 equity costs.
But not all costs?
Right. Rockhopper explicitly states it's likely they will need to raise additional finance to cover their share of the total project costs at the point of sanction that aren't covered by Navitas or the main project debt.
And that's because some costs fall outside the Navitas loan structure.
Exactly. Things like license fees, any Rockhopper-specific taxes, their own corporate G&A related to the project, those need to be funded directly by Rockhopper.
Plus, there's that potential decommissioning funding requirement from FI.
Yes. FIC has flagged they'll likely need security or funding for future decommissioning liabilities. Rockhopper estimates this could peak around US $40 million when Phase 1 is done. They're looking at options like bonds or other funding sources for that, but it's another potential call on their capital down the line.
So how big could this funding gap be for Rockhopper at FID? They gave some scenarios.
They did, based on that $1.4 billion Phase 1 cost and assuming maybe $1 billion in total project debt. In that kind of scenario, Rockhopper's own equity check could be somewhere in the range of, say, $64 million to $88 million.
That's a wide range and depends on final costs and debt levels.
Exactly. And importantly, those indicative numbers don't seem to include funding for things like the decommissioning of the initial wells drilled before first oil, or those other excluded costs like taxes and G&A.
So the actual amount Rockhopper needs to find could be even higher than that $64–$88 million range.
It could be, yes. Those are just indicative equity figures based on core project costs.
And where might they get this money from? They list possibilities.
Yeah, a range of options. Using more Umbrina Mare proceeds if when they arrive, tapping that insurance payout using their existing cash, maybe raising convertible debt or mezzanine finance, issuing new shares.
Or even farming down, selling a piece of their 35% stake.
That's listed as an option too, yes. A farm out.
But the report includes a pretty stark warning if they can't raise whatever funds are needed, right?
It does. It says very clearly, in the event funding was necessary and not achievable, then the group could not sanction the project. So securing their share of the funding is absolutely critical to reaching FID. It's the gating item for them.
Okay. Another major uncertainty, and one that complicates that funding picture, is the ongoing capital gains tax dispute with the Falklands government.
Yes, the CGT issue. This relates back to the farm down they did way back in 2012. And Rockhopper themselves say this dispute is making the project financing significantly more difficult.
What's the actual disagreement about?
It boils down to whether Rockhopper can reduce the original tax liability based on costs they incurred, what they call irrecoverable development carry. Rockhopper believes they can adjust it down significantly.
But Effie disagrees.
FEG's current position, according to Rockhopper, is that the full $59.6 million, that's around $75 million US dollars today, is still owed and would become payable around the time of first oil.
That's a massive difference in opinion. How are they accounting for this uncertainty? It sounds like they changed their approach.
They did. At the end of 2023, based on legal advice, they actually removed the liability from their books entirely, believing they were very likely to win the argument.
But now,
Because the discussions are ongoing and maybe the uncertainty level is perceived as higher, their accountants have required them to put some liability back on books. They've recognized a non-current tax liability of US $22.3 million.
so not the full amount FI claims, but not zero either. How did they get to that number?
It's based on a probability weighting approach. Essentially, the accountant's assessing the likelihood of different outcomes and booking an estimated liability based on that probability.
But crucially, there's still no agreement.
None whatsoever. Rockhopper stresses that the final liability could be materially different. It could still end up being the full $59.6 million if FI doesn't accept their arguments. Having this large unresolved potential liability hanging over them is clearly a problem for lenders.
Definitely adds complexity. The company also laid out its own view on the key risks. What were they?
They listed four main ones. First, the risk that their partners, mainly Navitas, fail to secure the main project-level debt funding needed for FID. Second, the availability of capital at the group level, that's Rockhopper's own ability to raise their share of the funds.
Which we just discussed.
Exactly. Third is oil price volatility, always a risk for project economics. And fourth is joint venture partner and wider stakeholder alignment, basically, keeping everyone, including FI, pulling in the same direction.
Right. And finally, the going concern statement. Did they confirm they have enough funds to operate for the foreseeable future?
Yes, the directors assess their ability to operate until at least September 2026. Based on their forecasts, which include current cash and the drawings available under that pre-FID loan from Navitas, they have a reasonable expectation of having adequate resources.
But those forecasts exclude some potentially significant future items.
Correct. The going concern forecast specifically excludes any potential future cash from Umbrina Mare and any costs associated with Sea Lion after sanction.
And it relies on an assumption about future funding.
Yes, the assessment is based on the belief that if additional funding is needed for FID, they will be able to achieve it. But, as they stated elsewhere, actually sanctioning the project is discretionary. They wouldn't proceed if they couldn't secure that funding.
Okay. So, wrapping this all up for you, our listener, we've journeyed through Rockhopper's latest results. We've seen Sea Lion making tangible progress towards a potential FID.
Especially on the financing structure and the confirmation of that much larger resource base.
Right. We've understood how that Umbrina Mare arbitration deal dramatically improved their 2024 financials, providing cash and a significant book asset.
And how they're cleaning up their legacy Italian business.
But we've also really dug into the remaining hurdles. The big ones seem to be Rockhopper securing its own specific slice of the FID funding.
Which could be a substantial amount, potentially tens of millions.
The final outcome of the Ambrita Mare Elmet case, although that insurance policy provides a helpful safety net.
Definitely reduces the downside risk there.
And this unresolved, and frankly quite large, tax dispute with the Falklands government, which is clearly casting a shadow over the financing efforts.
It's a complex picture, significant steps forward, yes, but also some very real challenges still to overcome before they can push the button on Sea Lion FID, now targeted for the second half of this year.
So here's a final thought for you to consider. Think about how all these different pieces connect. You've got an arbitration outcome against Italy, the sale of old Italian assets, a tax argument with the Falklands government stretching back years, and the intricate financing of a massive oil project.
They all seem separate, but they're clearly influencing each other, aren't they? Success or failure in one area impacts the options and pressures in another.
Exactly. What does this complex interplay, this juggling act, tell you about the sheer difficulty and the multifaceted nature of navigating huge energy investments in the world today? It's rarely just about the oil in the ground, is it?